The stock market is near all-time highs, tech IPOs are oversubscribed, the media says the economy is strong, unemployment low, innovation exploding, yet your grocery bill doubled, your mortgage eats half your income, and your retirement account feels more like a sandcastle waiting for one wave. That's the paradox of modern wealth. Everything looks rich on paper while the average American quietly drowns. Nominal wealth says you're doing fine. Real wealth laughs in your face every time you swipe your card at Costco. Most people don't realize this. A recession doesn't begin when stocks crash. It begins when your dollar stops buying what it used to. The collapse isn't coming, it's already happening in slow motion. They just gave it a friendlier name: inflation. Your 401k shows 6 figures, but your future purchasing power is half of what it was a decade ago. You feel it every time you think about retirement, and your chest tightens, just a bit. You're not imagining it, you are getting poorer, quietly, gradually, mechanically, and here's the part most want to accept. Wealth doesn't disappear in a recession, it transfers. When the storm hits, money doesn't burn. It moves from the unprepared to the prepared. The 2026 recession will be the cleanest wealth transfer of our lifetime, and the only question is which side of that trade you stand on. I'm not here to comfort you, I'm here to hand you the blueprint the rich are using. The 5 portfolio moves they're re-executing right now while the middle class argues about interest rates on Twitter. Before we build that plan, you need to understand the battlefield, because nobody wins a war they don't understand. The United States sits on roughly $36 to $37 trillion of federal debt. That number is thrown around so casually you forget how insane it really is. A trillion seconds ago, humans hadn't even invented written language. Now we add multiple trillions per year just to stop the ship from sinking. Interest expense, just the interest, is approaching $1 trillion annually. We're paying interest with borrowed money. You don't need to be a Wall Street analyst to know how that movie ends. The Fed is cornered, they keep rates high, debt collapses under its own weight. If they cut rates, inflation roars back like 2021 on steroids. There is no gentle exit. There is only pain distributed differently depending on which asset you hold. And while Americans argue about which political party broke the system, BRICS and the rest of the world are quietly stepping away from the dollar, settling oil trades in local currencies and accumulating gold like they know something Main Street doesn't, because they do. Think about the dollar this way: it's stock in the United States. Holders are shareholders. When foreign nations stop buying, stop holding, stop trusting, the price of that stock goes down, not on a chart, but in your everyday life. Bread gets more expensive. Gas gets more expensive. Gas gets more expensive. Housing becomes a privilege instead of a right. Your dollar loses the ability to command respect. Now place that on top of the everything bubble: stocks, real estate, venture capital, AI startups with no earnings, meme coins, luxury watches, farmland, you name it. Everyone is leveraged. Everyone thinks the Fed will save them because we've been conditioned like lab animals since 2009. You know the rule: by the dip the Fed always steps in. Liquidity always returns, the party never stops. That rule worked for 15 years until inflation shattered it. The Fed can't rescue markets without reigniting the fire they just barely smothered. They have 1 bullet left and 3 targets. Which one do they shoot? The truth is, they don't know. They're guessing, and if they guess wrong, the wealth of an entire generation evaporates in a heartbeat. But the real danger isn't the macro landscape itself, it's how Americans respond to it. They cling to 60/40ths like a security blanket. They leave cash in savings accounts earning less than inflation like it's protection instead of slow execution. They hold tech stocks they don't understand because someone on CNBC voice cracked about AI. They prepare for the last crisis, not the next one. Ask yourself something honestly: if your 401k dropped 40% tomorrow, would you know what to do? Would you hold, buy, panic, sell? Would you even have dry powder? Or would you be all in at the top like everyone else? Recession only destroys people who confuse paper wealth with real wealth. The rich don't make that mistake. They rotate before the crash, not after. They buy assets when blood hits the floor, not when champagne is flowing. They prepare while everyone else argues about whether we're technically in recession yet. The 2026 downturn won't be a normal contraction. It will feel like 1929 and 1970 had a child deflationary collapse in asset prices, mixed with inflationary decay in purchasing power, a hybrid monster. And hybrid monsters punish portfolios built on outdated rules and blind optimism. Money sitting in long bonds will rot. Money sitting in pure equities will bleed. Money sitting in savings will starve slowly. But there is a blueprint. 5 moves the ultra-wealthy are already executing quietly, without press releases, without TikTok hype. You'll see it clearly if you stay with me. The window is open now, but not for long. In 1929, America was drunk on prosperity. Stocks soared, fortunes multiplied, and people quit stable jobs just to day trade because it felt like free money growing on trees. Then, like a candle gutted by its own flame, everything collapsed. Prices didn't dip, they fell off a cliff. 89% wiped out. Families turned from wealthy to worthless in less than 36 months. Men who owned skyscrapers ended their days renting basements. Not because they were lazy, not because they were reckless, because they were leveraged, exposed, unprepared. A deflationary collapse crushes those who sit on paper wealth without liquidity. But that's the first half of the monster. Fast forward to the 1970s. This time, markets didn't implode, purchasing power did. Inflation ate the middle class alive like termites in the wood that supports your house. It was slow, silent, devastating. Your dollars didn't vanish, they simply stopped buying things. One year you vacationed in Miami, and the next year the same money barely paid heating. Bondholders, the ones who played safe, was slaughtered. Their certainty was a coffin. For the first time, Americans learned a brutal truth. Cash is not safety. Cash is a melting ice cube. Now put those two beasts together. Deflationary asset collapse, meet inflationary currency decay. That's where we stand. We aren't walking into a storm, we are standing at the eye where both winds spin toward us. Asset valuations are fragile like 1929, but currency integrity is eroding like 1974. The Fed has no room to cut deeply without igniting the inflation furnace again. They have no room to hold rates high without suffocating dead serpents coiling around the economy. The wrong move collapses asset values. The right move collapses your purchasing power. In a hybrid crisis, both can happen simultaneously. Here's what most investors never ask. Which death do you prefer? A swift blade or slow poison? And more importantly, how do you avoid both? The traditional 60-40 portfolio worked for your parents because they lived in a world where the dollar was strong, rates were stable, inflation was mild, and global trust in America was unshaken. Stocks created upside. Bonds created income and protection. That world is gone. 60-40 is a monument to a dead era. In the next recession, 60-40 isn't a portfolio, it's a suicide note written in pencil. Look at bonds. People think they're safe because they pay interest. But safety isn't about nominal return, it's about real return. If a bond pays you 4%, but inflation steals 8%, you didn't earn anything. You lost 4%. That's a negative real yield. You're walking backward on a treadmill and wondering why the wall keeps getting closer. Bonds in a high inflation cycle aren't protection. They are confiscation disguised as stability. Long-term bonds today are a promise that your purchasing power will deteriorate slowly, methodically, invisibly. You get a check every month, but that check buys less groceries, less fuel, less life. The markets won't crash your bond portfolio. Your own currency will. And the worst part, you'll feel safe the entire time. You feel the quote, "What worked for our parents will not work for us. Let's sharpen it. What made your father wealthy will make you poor." Cash in a savings account isn't wealth, it's future poverty with good manners. Bonds aren't protection, they are delayed regret. Blindly holding S&P index funds in a supercycle top ISNT discipline. It's denial disguised as patience. But before you start thinking this is hopeless, understand this wealth doesn't vanish, it changes hands. There is a strategy. There is a structure. And the wealthy are already moving in silence while everyone else waits for confirmation. Winners don't wait for confirmation. They move when the risk is asymmetric and the upside unfair. So let's talk portfolio construction, not theory, not motivational fluff, but moves. 5 of them. The same adjustments flowing through hedge funds, family offices, and private capital circles, the ones CNBC won't talk about until after the VA already happened. And it begins with defense, because offense means nothing if you're the one bleeding first. Imagine wealth as a fortress. Most Americans build walls out of cardboard, savings accounts, long bonds, tech-heavy portfolios built on hope. In 2026, wind won't knock those walls down, reality will. But the wealthy, they don't build cardboard, they build in layers, redundancy, optionality, liquidity. They expect the attack and they position to benefit from it. So let's break the silence. 5 moves, 3 defensive layers. 1 objective, not just to survive the 2026 recession, but to come out on the other side owning assets others were forced to surrender. Wealth protection isn't about picking the perfect stock, it's about eliminating fragility. In 2026, fragility dies first, and most portfolios today are as fragile as glass under a hammer. The rich understand that resilience begins with insurance, not speculation, and their insurance is tangible. That's why layer 1, the foundation, is simple. Real assets you can hold, not promises, not paper proxies. I'm talking about gold you can carry and a calculated slice of Bitcoin, not because you worship volatility, but because it's the only asset class outside the reach of central banks and political desperation. Gold is wealth that governments cannot print. Bitcoin is wealth they cannot freeze, at least not as equally. You don't need to bet your life savings on them. You only need enough exposure so that if fiat confidence cracks, you're not standing there with dollars that burn like confetti. 20%. That's the defensive shield. Some call it paranoid. The wealthy call it insurance. Now we move to layer 2, the engine. In a recession, speculation starves, but real demand never dies. People still eat, they still heat their homes, They still drive to work and turn on lights. That's why the rich are rotating into productive hard assets, energy, uranium, oil and gas infrastructure, and companies with cash flow strong enough to laugh through downturns. They're buying farmland because food isn't optional. They're buying essential REITs, not malls, not trendy co-working spaces, but logistics, data infrastructure, and housing where demand strengthens when times get tough. They don't care about hype, they care about necessity. What can society turn off? That's where capital hides during chaos. 50% of the portfolio belongs here, not all at once, not recklessly, but gradually. While the crowd is still delusional and greedy, most investors wait until the crash to hunt bargains. The wealthy prepare a watch list now. They track cash flow, debt structure, energy producers, farmland syndicates, and when panic selling turns these assets into clearance racks, they buy like predators, not victims. Which leads to layer 3, liquidity, 30%. Tactical cash, not savings accounts rotting at negative real yield. I mean short-term treasuries. Rolling T-bills, instruments that pay while you wait and unlock the one advantage retail never has. Ammunition, because when assets puke 40% overnight, cash becomes a weapon, and the person with liquidity buys at liquidation prices while everyone else begs the market not to take what little they have left. 5 moves, not theory, execution. Move 1. Cut, long duration exposure. Bonds are not protection, they're slow erosion. Shift to short-term treasuries and regain control of your timeline. Move to allocate 5 to 10% to physical gold and a strategic slice of Bitcoin. Call it catastrophe insurance, not hope. Move 3. Rotate from hype to necessity. Energy, water, agriculture, infrastructure, businesses. The recession cannot starve. Move 4. Build a recession watch list now. Do not wait for CNBC to tell you it's safe to buy. Opportunity arrives when blood is warm, not when charts look pretty. Move 5. Stay liquid. Dry powder wins wars. Half the fortune made in recessions isn't made by brilliance, it's made by survival plus timing. You don't need to be perfect. You only need to be prepared. The recession everyone denies today will be the story they pretend they saw coming tomorrow. But wealth doesn't wait for clarity. It rewards the ones who act in uncertainty with a framework, not fear. So remember 3 truths before you click away. First, the system isn't stable. It's stretched like glass, and history has no mercy for those who assume it will bend instead of break. Second, old strategies are obsolete. 60/40ths died with cheap money and predictable inflation. We live in the hybrid era now, and hybrids devour tradition. Third, recessions don't destroy wealth, they redistribute it right now. Quietly, efficiently. You have a choice. You can be the liquidity that gets eaten or the liquidity that eats. I am tracking 5 specific energy stocks right now. Companies with fortress balance sheets and leverage to rising commodity demand. I'll break them down in the next video. Valuations, entry ranges, exit logic. If you want to see the list, subscribe, turn on notifications, because when the window closes, it slams and nobody knocks twice. We don't predict crashes here, we prepare to profit from them.